Good day, Watchman. I know that I didn't have a night watch video last night. It was very late when I got home, and I was already intending on replacing it with this 10Q analysis video anyway, and it took me quite some time to dig through all of this and write up the script for this episode. So we're gonna go ahead with it now. I have delved into the 10Q as detailed as I could, and I have assembled a list of points to highlight, and we'll go in order from worst to best. So we'll start off with the bad stuff, and then as we progress we'll get to the better and better things. Also have a brief breakdown of some of the points made in the conference call, and we're gonna get to everything as quickly as we can. So, okay, we can start off with the biggest red flags that I've found in the 10Q. We're looking at a very high net loss and a rapid cash burn. This is not anything that we didn't already know about, but it is a red flag as far as institutional and long-term active growth investors are concerned. The financial metrics, the operational metrics, they show very severe imbalances. Looking at page 4 here, the net loss significantly escalated to $53 million for the quarter, compared to $9.5 million here in the same quarter last year. Now, this is sort of to be expected with the ramping up of the business. The operational loss is the main key factor here. See, we have almost 31 million, and the problem that I see with this is that of these three numbers right here, the lowest one is the most important one that we want to see money being spent on, R&D. We want this number. Look at last year. We have a slightly higher R&D than we have sales and marketing. Now, we're going to expect general administrative to be higher, but not by that much. We don't want to see it, what is this, 2.5 times? This is over 3 times the amount of G&A than we have for research and development. This is not acceptable. We need this number to be higher than sales and marketing at the very least, and this number needs to come back down. If it's twice as much, that's fine, but we don't want 3.5 times the amount spent on G&A than on research and development, especially not as an AI company. The corporate instability is reflected in this massive deficit that we see here. Let's go to page 3. You see our deficit is, where is that? What was it? It was 430 million. Yeah, right here. Okay, so this is from the end of the year. This is Q4's deficit. We've gone up over 60 million to the total deficit in 3 months. That's 20 million. We're adding $20 million to the deficit every month. That's not good. This number needs to start coming down. And of course, it's not going to start coming down until we start seeing profit. But we need this. This needs to happen. This needs to stop going up, and it needs to stop going up so rapidly. The next red flag is another one that we already know about. It's the delisting risk. Okay, so we got the formal notification from NASDAQ on February, it was like the 23rd, 24th, something like that, that we were non-compliant due to the minimum bid requirement with a dollar price mark for 30 days. The grace period for that expires on the 24th, I believe, 24th, which is making management consider a reverse stock split if they can't organically achieve the compliance. So this is not institutions are looking at this, and there your counter argument could be, hey, well, we're looking at filings and people are Vanguard's buying, BlackRock's buying, JP Morgan is buying. Yeah, they are, but if you can believe, go ahead and bet on the fact that if it gets closer to the deadline and we're not showing some kind of vast improvement on the numbers, if July doesn't happen, these institutions are going to jump ship. And I don't know that 100%. Of course, I don't know anything 100%, but it's very, very likely that if things don't turn around soon, then they'll most likely be jumping ship. Another red set of red flags is the supplier bottlenecks that we have. If we looked at page 8, which is not something that was not discussed anywhere. Let's see, where is this at? Yes, here, this whole paragraph right here. Okay, so the company relies on sole source suppliers to manufacture some of the components used in its product. The company's manufacturers and suppliers may encounter problems during manufacturing due to a variety of reasons, any of which could delay or impede their ability to meet demand. The company is heavily dependent on a single contractor in China for assembly and testing of its products, a single contractor in Japan for the production of its transmit semiconductor chips, and a single contractor in China for the production of its receive semiconductor chips. Okay, so very reliant on China and Japan, these specific companies in those countries, and if something happens with those specific companies or the countries that they reside in, or it could lead to supply issues, which is not good. Never a good thing to run into supply issues for your equipment. That's a red flag. We need to diversify where we're getting things from, where we're getting our equipment from, just because of that reason. We don't want any bottlenecks. Now we have the next red flag is going to be exposure on the balance sheet to highly volatile assets, mainly Bitcoin. We want to, let's go to page 3 again. We can see that crypto assets, we have $57 million in crypto assets, where we had 92 million at the end of the year. We have reduced that quite a bit. Now, what this caused is let's see, where is it at? Loss of, maybe that's on a different page. Let me see, what page is that? Yeah, it's on page 6. Alright, so what that did, look, it says loss of sale on Bitcoin, 822,000. We lost almost $1 million because the value of the Bitcoin has changed by $16 million, since the end of the quarter, with the drop in the Bitcoin price. If they're going to hold on to this and use it for operational funding, then we need Bitcoin to go back up, and it hasn't been doing as bad recently, but we need it to be back where it was when we got the Bitcoin. That'd be nice. Go back up to 120K. But that's not going to happen overnight. All right, so those are the really bad things. Now these are we're not quite out of the deep waters yet. There are there's still a heavy dependence on dilution and immediate needs for more capital. And corporate survival is going to remain reliant on aggressive financing, and it's look here. What was it? Page 45. It says here, this paragraph here, we have financed our operations to date primarily through the issuance of equity securities. This is dilution. Proceeds from the exercise of warrants to purchase common stock, sale of debt instruments through the sale of Bitcoin, and as of May 15th, we utilized our July 8th at the money program to sell common stock for net proceeds of $32.4 million. We raised net proceeds of $58 million on May 4th in a registered direct offering. This was the 60 million, 109 million shares from Titan. We will need to raise additional proceeds via the issuance. We will need to, right here. These are keywords. They're not saying, hey, we might, we may need to, we will need to raise additional proceeds via the issuance of equity securities and or the sale of debt instruments, which is selling more Bitcoin, in the remainder of 2026 to fund operations. So they need to sell their Bitcoin and or dilute further to fund operations. In addition to raising proceeds from the issuance of equity securities and debt instruments, the company does have sufficient cash and cash equivalents, Bitcoin, and other resources for the next 12 months. Okay, so they're not dying, they're not drowning, but they're telling us, hey, don't be surprised if we dilute more, because we're going to need to do something to raise cash. They're profitable, but they're not profitable enough. Okay, so that's something that we need to be looking at. Next is customer revenue diversification. We are not seeing the diversification that have been wanting to see in this report. We can look here and see that the company's AR is derived from revenue earned from customers located throughout the world. Yeah. The company performs credit evaluations of its customers' financial conditions and may, in certain circumstances, require full or partial payment in advance of shipping. As of March 31st, there was no allowance for credit losses. As of March 31st, the company had 2 customers accounting for 65% and 31% of accounts receivable. We all know who these 2 customers are. As of December, the company had 2 customers accounting for 65% and 32% of accounts receivable. So it's dropped by 1%. We see that it went from 30 million to 29.5 million. It's not, we got to get away from these guys. We got to get away. We got to diversify revenue streams. Whatever they have cooking with all of these contract fees and all this stuff, it needs to come to fruition, because as long as we have the most of our revenue coming from Silex, Vivasor, aka Henry G, it's bad. It's not a good thing. We need to get more sources of income, because Silex is broke. I don't understand how they can continue to. I mean, they're obviously going to have to sell either another part of Semner, or they're going to do something with this recent acquisition they had of this other company. Whatever, I don't even remember the name of it and the deal that they had behind it. But they need to sell some stuff. They need to figure out what's going on so that they can pay us, so we can get this money converted from AR to money in the bank account. And that's part of what happened on the call when I asked about the converting AR into money. Brett jumped in and cut Nate off real fast. Trying to, I don't know, guess do damage control on, what he was going to have to say about this accounts receivable, because I believe he knows, hey, we need to do something about this, but I don't think that he can do anything about it. I just really don't know what's going on with Silex and with all the rest of the how they're going to pull all this out. Alright, the next point is I already talked about G&A, general administrative costs, increasing. But this is also, G&A is going to be, that's payroll. So, as we're hiring more people, of course it's going to go up. It's legal fees, so while we're trying to figure out all these lawsuits, of course it's going to go up. It also includes acquisition costs. So as we're gathering more members into the company, more affiliates, then it's going to go up too. That makes sense. We just want the R&D to be more. If we're going to spend money, I would much rather see it being spent on R&D than these other things they're spending money on. Alright, so I already talked about related parties. What else was it? I think that's just about it for the bad. I have a couple of points that are pretty good to look at. We can get to those now. Net revenue climbed vastly from last year. We had $500,000 in revenue last year, and we've got $3.5 million now, most of which comes from what they have a live event production revenue. Okay, so that's not this is WISA down here, consumer audio products, less than $1 million. So when we spin these guys out, we're not losing a whole lot. People are complaining, hey, we're going to lose whatever revenue they bring us. It's not really that much compared to what we can get from live events and data capturing. It's not not that big of a deal for the spin out. But see, our gross profit is very low, $100,000. But revenue is climbing year over year. Oh geez, sounds like the ladies are getting upset in the other room. Alright, so we are also clearing debt. Management is actively clearing long-term debt. We'll look at 22. On February 14th, the company paid a portion of principal and interest of $500,000 as a result of the February public offering. And for the 3 months ended in March 31st, this first quarter, the company paid an aggregate of $3.9 million in cash, resulting in the convertible note being paid in full. Okay, so this was a note that was formed when the company went public as DVLT from WISA, and it is now gone off the balance sheet. In January, the company fully repaid the outstanding balance of the convertible note. The repayment satisfied the remaining principal and any interest outstanding under the note as of the repayment date. Following the payoff, the convertible note was extinguished and no further amount remains outstanding under the agreement. Good deal. Paying down debt. It's always good to see. Now we have a lot more to go, but they are making progress, even if it is small progress. Now, regardless of whether it diluted us or not, the $60 million from the RDO is a massive post-quarter funding infusion. We can see that, let's see, so yeah, we got the $60 million RDO that we netted $55 million from. We have the term sheet with Silex, positioning us for another $120 million for the Sanctum network to be built. And the Vivasor share trade is, I'm really hoping that their deal with this is to just sell those shares to make some money. That would be another, what was it, $50 million? I don't know what the plan is with that, but the only value I can see to doing this would be to sell those shares for money. The same way that Silex sold our shares back in December or whatnot, while BNY was also selling our shares, unknowns to everybody else. Another good thing that we see is on page 43, and talks about the data science division focused on the delivery of cybersecure, privacy-protected data management and monetization technologies. It shows that our patented semiconductor and digital module technologies are currently being deployed by several key customers, including Bang & Olufsen, Harman Kardon, Klipsch, and other leading electronics manufacturers. These guys, Harman Kardon, these guys make these are good audio guys. They make really high quality audio products. I need to do some more research into these guys, Bang & Olufsen. But yeah, Harman Kardon and Klipsch, these are not low end customers. So as long as we have people that are willing to use our products, then as we grow and increase technology and increase influence, we'll gather more of these big name customers. Okay, so as far as the call, the company reiterated its guidance of $200 million for the year, and a lot of people are in disbelief because we only got $3 million for the first quarter, but we still have 3 more quarters to get that. And if July is as big as the management wants us to believe, then it could very well happen. It's still a possibility. And 100% is a possibility. We got $90 million in fees from contracts signed in the first quarter, and a lot of people were thinking that most of that was going to be converted to revenue, and it will be, but just not when the contracts are signed. That the revenue is going to come as the stipulations of the contracts, as the work is performed. So over the next quarter or two, we'll see that the fees turn into revenue on the balance sheet. I'm expecting that Q2's balance sheet and the earnings report is going to be significantly increased over what we saw yesterday, and if not, then definitely from Q3 and 4. Like he said, a lot of things are going to happen in July, and it's going to be very important for us as far as like regaining compliance and hitting the $200 million guidance for the year. The spin out. Now, I need to do some more research into this David Reese guy too, because I didn't have time to look into him. If anybody knows anything about him, go ahead and let me know in the comments. But he's going to be heading ADO, and we're not gonna, it'll allow DVLT to focus more on the data aspect of the business, as opposed to having separate entities that they need to manage and share a balance sheet with. We won't have any of their losses. We won't have their gains anyway either, but their gains are not very much, so we won't be tied down by their losses, which is more important to me, I believe. The rollout of the Sanctum network is on schedule. If you heard Nate's explanation regarding the Mars-made protocol and quantum-ready technologies, he's telling us that it is not only on schedule, but it will increase the speed at which they're able to successfully bring these nodes online. And this is that's good news to me, because I was thinking that implementation of these technologies was going to slow us down. Maybe they would have to take these sites offline in order to integrate all the CyberCatch technology into them. But if you go back and read maybe the transcript or go back and listen to the audio, what he was saying makes sense. It's Q-Day. If you go look up Q-Day, this is what he said, something about flipping the switch on Q-Day. This is when everything is going to need to be quantum ready. And if you're not ready at that point, you're going to be behind. So the plan right now in the schedule is that we'll be ready before the quantum day hits us, which is a good deal. Now, I was a little perturbed by him avoiding my revenue question about the Sanctum network, but it should just be common sense, I guess, that as they bring these nodes online and get them functional, we will start to see revenue from them. And if we don't see it in Q2, then Q3 should be a given. Especially if they still plan on, like they said, meeting the schedule, having 30-something cities ready by July, then we should definitely start seeing some more of that revenue rolling in. Alright, so there's two ways to look at all this stuff. You can, the cynical view is one of self-interest in corporate, padding, where people would see Nate, that he is deeply embedded on both sides of the company's loop. He operates as the primary control person of EOS Holdings, meaning that when DVLT transfers wealth or guarantees these massive stock payouts to insiders, he benefits through his private entity rather than his role at the public company. Furthermore, his personal compensation is protected regardless of the stock's performance. He's by pushing for acquisitions, he inflates the revenues to trigger his own little performance bonuses, while the core business is saddled with, net loss, a $53 million net loss. And by bringing parent companies like Silex and Vivasor into the board, he aligns the voting blocks with his seat, insulating himself from, protecting himself from shareholder backlash. I don't agree with most of this. I don't think that Nate's a bad guy, and I don't think he's some boogeyman out to get us. I'm more inclined to believe the non-cynical viewpoint, where Nate is executing more of an aggressive pivot to save a failing business. WISA was trapped in a downward spiral that was bringing in no money. and to transform it into a major AI infrastructure player, he's using Data Vault's stock as a kind of currency to buy revenue generating companies like CompuSystems and API Media without using what little precious cash the company has. And while the dilution is massive and it's painful for us in the short term, it's giving the company the scale it needs to secure things like the $60 million RDO. And partnering with Silex is not, I know a lot of people are going to hate me for this, but it really ends up being a good deal. Where on paper, as long as we can end up getting our money from them and clearing our balance sheet out of that debt, then it really ends up being a good deal. And as much as we all might dislike Dr. G, it's in his best interest for DVLT to succeed. It really is. It's not, there's no, I mean, it just doesn't make sense for him to just let us fail, or to throw us to the wolves, or to watch us drown. He loses a lot if that happens. So I don't, I really just don't see I don't take the cynical viewpoint on this. And I don't think it's a scam. It's the farthest thing from a scam that it could be. Alright, I've rambled on enough, and it sounds like the ladies need my attention in the other room. So I'm going to go ahead and close out. I'll let everybody drop whatever notes they want in the comments. Let me know what you think. If you have anything to say refuting any of the points that I've made. And I'll see y'all next week on the Night Watch. Until the end of all things, the Night Watch stands forever.